Salute, folks. It's your boy, the Insurance Junkie, your fiduciary fella, the all-star advisor Alonzo Hall, your social media insurance broker and registered financial consultant. This is Debt After Death, where we talk about how wealth really disappears when planning stops too soon. And in this sub-series, I'm walking you through real case studies from my career. Not hypotheticals, not theory. Real people, real outcomes, real lessons. Back in 2012, I was still fresh in the industry. A 79-year-old woman about to turn 80 reaches out to me, all the way confused. She had just gotten a check in the mail for about $1,500 from an insurance company, and she didn't ask for it and wasn't expecting it. And customer service couldn't explain it to her in a way that made sense to her. All she knew was this. She had taken out a policy when she was about 4 years old in 1934. That policy had officially ended. What she didn't know was why. Well, turns out it was an old-style endowment contract issued by Metropolitan Life, aka MetLife. Back then, policies were designed to either pay at death or mature at a certain age. She outlived it. Her premiums? Well, that was 10 cents a month. Let that sink in. Nearly 80 years later, the policy did exactly what it was designed to do. Now, here's where most people would miss the lesson. $1,500 in 2012 doesn't sound like much, especially in a world where people argue about returns and percentages. But that wasn't the win. The win was what she did next. She had held that check for over a month, unsure of what to do with it. No guidance, no explanation, just confusion. She came to me because she wanted clarity, not a pitch. So she asked for something simple. I just want to make sure I'm buried properly and, if possible, leave something for my grandchildren. So, we structured it. She purchased multiple final expense policies through Mutual of Omaha. $20,000 in a face amount to leave $5,000 each for her 4 grandchildren. And then an additional $15,000 strictly for the burial and final arrangements. No debt, no GoFundMe, no burden. But here's where it gets even better. That $5,000 per grandchild wasn't just handed over someday and forgotten. Each one was used to seed a policy for the grandchildren themselves. She funded them each with $100 a month per child, $400 in total. And then the parents took over the payment, obviously until she passed, and bequeathed that $5,000 to go into those policies. Now that's not just money, that's positioning. She didn't leave millions, she left momentum. And because these policies were set up early, with structure, guidance, and time on their side, they'll grow to be substantially larger than anything she ever had access to. Not because of magic, but because someone helped her aim the dollars correctly. So, ladies and gentlemen, this is the beauty of life insurance when it's done right. It doesn't have to be flashy. And, quite frankly, it doesn't have to be huge. It has to be intentional. That 10-cent policy didn't make her rich, but it proved a point. Small planning, done early and redirected properly, can outlive markets, outlive people, and outlive doubt. This is Debt After Death, where we separate looking good on paper from leaving your family protected. Because tomorrow ain't promised, but the bills always are. So, if you want help structuring things the right way, not hype, not guesswork, not confusion, then reach out. Legacy isn't always about how much you leave. Sometimes it's about how well you aim it. Salute, and see you guys in the next one.